US markets are down this morning on fears about Donald Trump's tariffs, which are due to kick in today unless he changes his mind. Also, Australia's business indicators in the December quarter were better than expected, as was a survey of China's manufacturing sector in February. And New Zealand's export receipts had a great December quarter. That's coming up in our 5 Things in 5 Minutes on Tuesday, March the 4th, an historic day in the global economy if Donald Trump follows through with his tariff threats. So, in today's bonus deep dive interview, we hear from ANZ Economist Bansi Madhavani in London, who has crunched the numbers on how much inflation might flow through to US consumers.
Based on what we saw during the 2018 tariff war period, our assessment is that around 50 to 60% of the price rises can be passed on.
But first, in 5 and 5 with ANZ, US stocks are down and US bond yields are down too, after another sign that the US economy is beginning to sputter under the weight of inflationary and growth fears from Donald Trump's tariffs, which are due to kick in today or not, depending on what Donald Trump says in his social media posts. As of 4 a.m. Sydney-Melbourne time, the S&P 500 was down 0.45%, the Nasdaq was down 0.65%, and the US 10-year yield was down another 4 basis points to 4.18%. A weaker than expected US ISM manufacturing survey for February was the catalyst. Here's ANZ Head of G3 Economics, Brian Martin.
The subcomponents of the index did illustrate that tariff uncertainty is weighing on the manufacturing sector. New orders fell 6.5 points to 48.6 from 55.1 in January. And employment also fell, dropping 2.7 points to 47.6, so back below 50. Both of those two subcomponents would suggest a hesitancy on behalf of businesses to hire and to place new orders. So the manufacturing sector, therefore, flagging heightened vulnerability, at least in the short run, as long as tariff uncertainty prevails.
As of 4 a.m. Sydney-Melbourne time, the US dollar index was down 1%, and the Aussie dollar was up 0.48% at 62.45 US cents, while the Kiwi was up 0.55% at 56.31 US cents. Number 2, Australian business indicators of company profits and wages and salaries in the December quarter were better than expected yesterday. ANZ senior economist Adelaide Timbrell says the data has shifted the chances for Q4 GDP to be better than her current forecast for 0.6% growth.
This tells us that the economy likely did accelerate materially in Q4, which puts us in great stead for a stronger economy and a stronger momentum through 2025. If we do see a 0.6% quarter-on-quarter GDP result, that will also likely slow the Reserve Bank in terms of their easing cycle. We think that their next rate cut is in August, and a 0.6 quarter-on-quarter GDP result would support that. We don't think the Reserve Bank is cutting rates in order to stimulate economic activity. They're more just taking the handbrake off some of that restrictive monetary policy measures.
Number 3. Also in Australia, the monthly ANZ Indeed job ad series showed a 1.4% drop in February from January, although January was revised up. And so it means in 2025, job ads are actually down only just 0.1%, essentially stabilising near their levels from last August. Here's ANZ economist Sophia Angala.
Some of that stabilisation that we've been seeing in the ANZ Indeed job ad series over the past couple of months follows that robust employment growth of around 44,000 that we saw in January. This shows that there's still robust demand for labour in the market, but this was met by robust labour supply, with the participation rate reaching a record high of 67.3%.
Number 4. In New Zealand yesterday, there was some good news for the economy from the export sector, where there was a 3.1% rise in the terms of trade in the December quarter, which means a certain volume of exports will generate enough revenue to buy 3.1% more imports. Also, export receipts rose 20.6% in the December quarter from the September quarter, and imports fell 1.9%. ANZ New Zealand economist Henry Russell says it's not just that meat and dairy prices are particularly strong.
We're actually also seeing fairly strong growth across volumes as well after a fairly strong production season. But there are still some challenges on the horizon, with parts of New Zealand currently experiencing drought conditions, and that could potentially weigh on late season production and even affect the coming season if it persists.
Number 5. In China yesterday, the Caixin measure of manufacturing performance in February was slightly better than expected and in expansionary territory. ANZ senior China strategist Xiao Pengxing saw 3 reasons for the improvement but doubts it can last long.
The first reason is the steady domestic recovery after the holiday work resumption. The second reason is because of the front-loading U.S. demand ahead of the tariff. The last reason may be the business outlook in China remain intact because the 10% tariff increase in February looks marginal. We expect that the U.S. tariff will have some negative impact starting from March, but February number at this moment looks still strong.
We'll have more from Xiaopeng tomorrow in a deep dive on the importance of China's National People's Congress, starting tomorrow. Now, in our bonus deep dive interview, ANZ Economist Bansi Madhavani goes deep into the effects on global growth and inflation of Donald Trump's tariffs due to take effect later today. She says economic uncertainty has already surged and is already dragging on US consumer spending.
Our assessment is that US growth is set to slow this year. We are forecasting GDP growth at 2.3% versus 2.8% in 2024. So far, the softness that we've seen in data is largely based on survey indicators. It is likely that current anxiety is getting reflected rather than hard recession risks. So we remain watchful. The longer this uncertainty persists, the more the risk is that this softness spills over to hard data from survey data. So we need time and we need more data to determine if underlying economic impulse is indeed affected by tariff-related concerns. I think coming to inflation, our baseline view is that core PCE inflation, which is the broadest measure of price pressures in the economy, is likely to average 2.4% this year without any impact from the tariffs. But the reality is that tariffs are here and more seem to be on the way. So our estimates suggest that tariffs announced and implemented so far, which are 25% tariffs on goods from Mexico and Canada, and a total of 20% of tariffs on goods from China, could add 0.585% to the core PCE. Now look, this calculation does not include any offsets or second round impact, and not all of the price rises may be passed on to the consumers.
So how much of this 0.585 of a percentage point rise in prices is likely to be passed on to consumers? And how much of it might be sucked up by firms in the form of lower profits?
So look, it's not clear that all of this 0.585% rise in inflation will be passed on. There are many variables in determining end consumer prices, and there could also be economic offsets. Now, these offsets could include exporters charging lower prices. It could be the exchange rate adjustment. It could be substitution to other countries' imports, to give you some examples. So it's important to bear in mind that given that increase in consumer sensitivity to prices, businesses may be unable to pass through price rises without hurting demand. So based on what we saw during the 2018 tariff war period, our assessment is that around 50 to 60% of the price rises can be passed on. What that may mean in terms of net rise in core PCE would be around 0.35% impact. So basically, depending on the extent of pass-through, the timing of price rises, we might see core PCE in the range of 2.6 to 2.9% this year versus the 2.4% rate that we have in a no-tariff world.
So what's the potential impact on Fed policy?
So I think what the monetary policy is grappling with currently is this extreme amount of uncertainty and the wide range of outcomes on the back of it. President Trump has also said that reciprocal tariffs are on their way on 2nd of April. Very little is known currently about their scope, their design. So what the Fed will watch for is how potential price rises percolate to the economy. If it is a one-off shock, the Fed can be patient and allow data to settle. In parallel, what's happening in the labor market is also important. Remember, the Fed has dual mandate of price stability and maximum employment. So for the Fed, it's a lot of known unknowns at this point. And what the best course of action for the Fed could be while it deals with those is that we think they will remain patient. The labor market is cooling but isn't rolling over. Economic activity still remains strong despite the softness in survey data. So the Fed is likely to ride out the storm. Our forecast is that the Fed keeps monetary policy on hold for the first half of this year and resume rate cuts in the second half once they have more certainty on policy direction.
Bansi Madhavani there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, March the 4th. Catch you tomorrow with a deeper dive into China's National People's Congress, starting tomorrow. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.